All right, let's start, and we will see when Bassel joins. So, hello everyone. Good afternoon. This is Moshin Mujtaba from Qatar Stock Exchange. I will be your host today for this third of the series of the COVID-19 webinars. We have discussed overall impact on the industry and the Qatari market. We last time looked at the impact on the customer or investor sentiment in terms of portfolio construction. And today we will dive a little bit deeper into the banking sector and see how the industry gurus are thinking about what the impact will be for this. So today is a little bit significant also because Qatar has been successfully been able to flatten the curve where we have seen the worst, and today the second phase of lockdown restrictions are being eased, is implemented. So we will be going back to the malls and to the parks and beaches. 50% of the workforce is back to work. So yes, I think collectively we have been able to flatten the curve. So congratulations to everyone. However, one curve that we haven't been able to flatten is the market. The market continued to rise during the course of the COVID-19 since the pandemic was announced in mid of March. The market has comfortably traded in a positive territory. With that said, I would go back to our panel and make the introductions there. Omar is joining us from KPMG. He's a partner at for financial services, and our very well-known Dr. Seetharaman from Doha Bank. He has been heading the bank for over a decade now and has led to the transformation of the bank. We will be also joined by Bassel, the CEO of the Qatar Islamic Bank. However, we haven't got him so far, but during the course, I think he will be joining. Now, gentlemen, welcome to the QSE webinar series.
Thank you.
Before we get down to the business of discussing the outlook of the banking sector, I think I cannot avoid, or we cannot not have a discussion on the news that came out yesterday about consolidation in the industry. We have seen the market in the Saudi also reacting positively to the news of National Commercial Bank and Samba merger. We heard yesterday from Masraf Al Rayan and Al Khaliji Bank also that they are in initial discussions of merger talks, which will create one of the largest Islamic banks in the industry. So please share your views. Omar, if you could have an industry perspective, given that you look into the books of most of the banks in Qatar.
Thank you for that kind introduction, Mohsin. I'm actually joining from London at the moment, where I am somewhat stuck given the current situation. But pleasure and privilege to be invited to share the forum actually with obviously Dr. Seeth and Bassel to join us later on. You couldn't have timed this seminar any better actually, Mohsin. I'm not sure you planned it that way, but yesterday's announcement and then today's seminar, the timing was perfect because what we saw announced yesterday is what we have been hearing many practitioners, many industry experts talking about for a very, very long time. And it's something that's actually been called for on numerous occasions. We saw positive steps last year where we saw Barwa Bank and IBQ come together, which was a step in the right direction. And as you rightly said, we've seen announcements in Saudi with NCB and Samba, and also earlier last year with Kuwait and Bahrain with AUB and KFH coming together. So we've seen a flurry of M&A activity in the region. And I think the general view has been in Qatar given the number of banks we have, given the demographics and the size of the market, there is clearly a need for further consolidation. I think that's been the general consensus. And I don't think it's just because of the size of the market, but I think it's because of just economies of scale and growth. We've seen growth in the banking sector for a number of years, but recently there's been challenges in the market. And I think there's been clear recognition that we do need fewer, but stronger and larger financial institutions with the deep pockets to be able to invest in technologies and people that's needed for future growth. So certainly the step in the right direction and a positive announcement that we saw yesterday. And I think if it comes off and it works out, it will be a positive, because we have seen in the past situations where transactions and mergers do not actually see through to fruition. But I certainly think in this situation where you have commonality in the shareholder base, which we have with both these banks, I'm hopeful and positive that we can see a good outcome.
Interesting. So your bets are on for this merger to complete.
If I were a betting man, yes.
All right, Dr. Seetha, where do you see this industry going in terms of this news that came yesterday? Do you think more such announcements would come? And how do you see this particular merger going forward?
This is a changing phase of the world and changing phase of financial services. In my pursuit of interpretation, it's expected. If you look at changing dynamics, scale does matter. You need to have business combinations which will be in a position to service all the stakeholders. From a regulatory perspective, you need larger capital base because banking becomes totally global. With digital governance taking a shape, your market access becomes total in terms of a global customer base. So you have access to all the markets. It depends upon how you conceive, how do you create a prototype to have a global space. Number one. Number two, changing the cost structure. We are clearly seeing revenues are going to be shared between the technology companies, postals, and the conventional banks. So it's difficult to distinguish between the technology companies and the banks. So essentially revenues are going to shrink. Cost has to be rationalized. You have business force outsourcing, knowledge force outsourcing, and again, you have a flat wall where you can have resources walled over. Survival of the fittest. It means you need to have cost efficient and convenient mechanism for you to operate as a business. And again, when you consolidate financial service between the banks, again, aggregation of services as one-stop financial service is also possible. Whether banking or insurance, stocks or mutual funds will also be combining into forces so that the customer get the value advantage. When it comes to overall governance model, now social risk management is going to play a very important factor. So we are all conscious of the fact that risk management enterprise-wide has to be integrated in substance. Currency risk, counterparty risk, and again, the technical recession, the great recession will have a serious consequence in your asset class. And you have to necessarily revalue your complete business and then try to optimize the forces. If you look at the bigger picture, if you have a sustainable journey in your mind, then industry consolidation is bound to happen. That's what has happened in Saudi. And again, we have seen the trigger in Qatar as well. In a market space like Qatar, where you have 10 local banks, 7 foreign banks, it's too much. So you need to have a large-scale operations, whether conventional or Islamic. And again, aggregation of various services, as I mentioned, will be the new phase of financial service in Qatar.
Well, I think with that,
gentlemen, I'm sorry.
Welcome, Bassel.
I'm sorry to join you. Yeah.
No, I think your timing couldn't be perfect. I think you have a knack of timing the market. So welcome on board. We were just discussing the impact of yesterday's announcement on the industry. And I mean, Omar and Dr. Seetha have already shared their views. And I want to, maybe this is a bit more personal for you. How do you see I mean, you have enjoyed the status of the largest Islamic bank in the country, but there is now new boy getting on the block. How do you feel about that?
And generally speaking, I think actually competition is good for the market. And as Sita was saying, I've actually heard what he was saying there. We are overbanked. Yani compared to the size of the market, we are overbanked. It is only natural that at one point in time we'll see some consolidation in the market. Having more or stronger institutions helps the whole sector. It doesn't help one bank versus the other. It helps the whole sector in general. If I actually definitely I would wish them luck yani, in the talks and in the process itself, like we wished at the beginning Rayyan, IBQ and Barwa luck, and it ended up with IBQ and Barwa. I think it's a positive thing or a step in the right direction, and we wish them every luck.
That's great. I think Sita mentioned survival of the fittest is the name of the game. So with that, I think I would like to take things forward and dig a little bit deeper into all the conversations that we will have today, particularly around the banking industry. But before that, I just wanted to step back a little bit and see the phenomenal growth that Qatar has seen compared to other markets globally since 2002, since the early days of when I arrived, at least in Doha. This is how the market has grown tremendously. And banking sector is no stranger to this growth. It has actually outperformed the rest of the market. So kudos to all of you who have been the driver of that growth. So welcome to this new era where we are certainly going to have some challenges. So without further ado, I would jump into the further discussion where I invite Omar Mahmood to give us an industry perspective of what you think as KPMG, the industry, how the industry has been affected by COVID-19, and what changes do you foresee apart from consolidation and mergers and acquisitions? What do the banks need to do going forward?
Thank you for that, Moshin. I do need to be careful what I say. We're two leading industry practitioners also on the webinar. I must make it clear that I'll be given the outside-in view because of the fact that we deal with obviously a cross-section of financial institutions in the market, as you said. I do have a slide here. I don't intend by any means to go through each point. I'm conscious of time. But what I would say maybe at the outset, just to set some context, is if we compare the current situation to 2008, I think it's been alluded to by numerous industry professionals that clearly 2008 was more of a financial crisis at the outset with liquidity and capital challenges. And 2020, we've got a health pandemic that has resulted in obviously financial sector implications. But I think there's also certain specific differences between then and now. In 2008, there was a trust issue. Bankers were under scrutiny. There was issues around culture, around remuneration from a global perspective, and bankers weren't necessarily favored. In 2020, we've got the situation where bankers to some extent are being looked at as the saviors and as the ones who are actually facilitating and helping the recovery in supporting the economy as a result of a health pandemic. So that's one very clear difference from what we saw in 2008. The second thing is really the use of digital channels and technology. If we look at now versus 2008, we've got a significantly higher proportion of usage of digital channels, and that's really helped facilitate and continue to drive the economy from the situation where a lot of people are in a lockdown situation. And I think the third thing is really, and someone alluded to this, another Qatari banking CEO a few weeks ago, saying the 2017 political issue has really, as they put it, acclimatized the Qatari banking sector. So that event and that incident in 2017 really helped banks become resilient, stronger, deal with challenges. And now sitting in 2020, what I understand the general view is actually we've come out of 17 stronger, and now to deal with 2020, we're in a much better position. So I think there are a number of factors that differentiate 2020 from 2008, and also that differentiate Qatar in terms of its ability to actually deal with the current situation. So if I just move on to the points that I've got here, what I'd like to maybe just cover is start on a positive note and just to look at and identify the positives that have come through the situation, and then talk about some of the challenges, because I think we need to be very real that there are challenges that are faced by the sector, and then more going forward, look at the opportunities. Certainly from a positive standpoint, the regulatory response that we've seen, swift, prompt, really demonstrating not just the willingness, but the ability of the powers that be to support the engine of the economy when it's needed. We've seen that in the past, and we saw it again in this situation a few weeks or a few months ago, where we saw the announcements of the $20 billion stimulus package, including the $3 billion package from QIB in terms of the guarantees, really supporting sectors, not just the SME sector, but sectors of the economy with deferrals, lower interest rates, and supporting the economy to continue to grow. And that was a very positive signal to the market. The second point, maybe just clubbing customer innovation and digital, this has really been a big positive. I wouldn't say that this situation has resulted in banks suddenly looking at digital. Banks that are represented by both Basel and Dr. Seetharaman and other banks in Qatar have been on a digital journey for a while. But really what we've seen now is just a laser-like focus on digital. I see it as a customer. The number of messages, the number of products that I'm being informed of by my bank has never been as much as I've seen now as I have from the past. So I think there's a real positive in terms of fast tracking of digital programs, greater customer centricity, not just because of regulatory demands, but just because of what banks are doing. And more importantly, digital acceptance. The number of board meetings that I've had, the number of meetings with the regulator via video conference, I probably had 0 in the last 12 years that I've been in Qatar, and the last few weeks I've had numerous. So the people and the generations that I thought wouldn't even do that are doing video calls, embracing mobile technology, and actually knowing that that's the only way to continue. So in terms of positives, let's say the regulatory response, digital, combining customer innovation and acceptance. And the third one is around employee engagement. I'm speaking to our clients, certainly, and obviously Dr. Seetharaman Basel will give us the practitioner's perspective. But while there have been challenges, numerous times I've heard bankers say that actually the employee engagement, the employee productivity and efficiency has really grown during this period. We've gone from a situation of 100% work from the office to at some point 80% work outside the office, yet banks have managed it smoothly. The transition has been smooth. Employees, the trust with employees has grown, and people actually have stood up and delivered at a time of need. So certainly from an employee standpoint, that the bond has become stronger with the employer. So I do think there's been a number of those positives that have emerged from the current situation that we've been faced with. Just moving on to the challenges, and as I said, there have been and there are real challenges. We ran a poll a few weeks ago for bankers in Qatar, and we gave them options around liquidity, credit, and capital to choose one of those as their most immediate pressing concern, and that was close to the situation just emerging. Liquidity was the majority answer, and the view was that liquidity, particularly dollar, was the major concern at that point in time. Since then, we understand that the liquidity concerns have been somewhat managed. Liquidity has come into the sector, and that's not as much of a concern as it was initially, but that was the clear concern at the outset. Dr. Seetharaman mentioned the revenue side of things. No doubt, revenue compression is a challenge and will continue to be one. We've got pressure on rates. We've got the regulator asking banks to be supportive. So we do have the situation where revenue and fees generally will come under pressure and won't necessarily be at the levels that we saw in the past. And credit quality goes without saying. At the moment, we can't really tell the true extent, but we saw in Q1 there was a 35% increase in provisions. that banks had reported. The banks are managing this. The banks have been resilient. The regulator has been supportive. But I think going forward, time will tell how sectors will be impacted and how that in turn will affect the bank. So I know that's being monitored very closely and being watched at the moment. And just maybe just to add upon operational risks, this is also a slight difference from 2008 with the way that the banks are working with employees that have been working from home and the digital channels. There's a whole new spectrum of risks that have been introduced, whether it's cyber, whether it's use of data. And a number of those risks are being managed by banks at the moment and are new. So that's something that banks obviously are dealing with at the moment and different from some of the risks and challenges that were faced in 2008. Just looking forward in terms of opportunities that these positives and challenges present. Fast-track digitization, again, I do think this digital and digitization word is somewhat overused, and I think really now they're inextricably linked with banking. There's not digital and banking, they're essentially one. And I don't think that the current pandemic has resulted in banks suddenly adopting digital. They have been doing it. But what I've seen is just a fast tracking. Board accepting the process, boards approving investment, and really a greater appetite to fast track use of technologies and innovation over the last couple of months, and that will only continue. The other one, maybe just to point on here that we've talked about before, sale of NPLs. We haven't seen much of that. I know, Moshin, you and I have talked about REITs before and looking at ways that banks can explore managing their real estate exposure off balance sheet. And that's something that may be looked at going forward as well. Cyber goes without saying, with the risks that are presented, it's just more of a focus on cyber. And branch rationalization really is something that we will see, certainly from our perspective going forward, when we move away from the bricks and mortar model as we're doing to more digital channels. Even in our business, it's clear that less real estate will be needed. That will result in cost savings. And yes, there's an emotional attachment behind branches, certainly we've seen, but from the conversations we've had with banks in Qatar, almost all of them are looking at this and will result in a positive impact on the cost base. And I must add, if you look at the GCC, Qatari banks, the cost to income ratios on average stands around 26%, and that's clearly already the lowest in the GCC region. But I think it's that focus that Qatari banks have had on costs will continue and will remain in the future. And the last point, maybe just on fintech collaboration. We saw the Qatar Fintech Hub recently launched. We're seeing now players applying to come into the market. And from speaking to CEOs across banks, they all see this as an opportunity rather than a threat to collaborate, to partner, to embrace, as opposed to being afraid and apprehensive of these new kids on the block. So that was really, just in a nutshell, a very high-level overview of some of our thoughts on the banking sector outside in.
Thank you for that comprehensive, broad outlook on the industry. And I know this report has just come out recently, so I'm sure we'll be able to share a copy with all the attendees on the banking sector perspectives. Before we move on to the industry practitioners, I wanted to invite the participants, the attendees, to a poll where they could help us understand where they sit in their understanding of the industry, of where things are going. I am launching the poll now, and the panelists will have the opportunity to influence people during the course of conversation. So you are not able to vote right now, but the attendees voting has started. There are questions around the asset classes people are comfortable in investing. So I invite the attendees to please look into your screen where you can start voting for the poll that has just started. So the questions are around asset classes, whether it's Qatari equities, global equities, real estate, gold. We're also asking people whether they intend to buy any real estate in the near future, or whether they want to take any mortgage loans in the next 6 months, or personal loans in the next few months. And so we are starting to see some responses, and we'll share the results at the end of these initial 5 minutes. We've also asked people about which sector do they think will come back quicker than others. So whether it's industrial, banking, consumer, insurance, telecom, real estate, or transportation sector. I think there is a even split between the consumer and the banking sector as of now. So let's see how people eventually respond. But yeah, this is interesting. While we are having this poll going on, maybe we can ask Dr. Seetha to share, some insights into what Omar just mentioned around digital acceptance and digital innovation. You're starting to have board meetings and within the industry, also within the bank, you're having a number of meetings. How quick was this digital acceptance in your bank?
Well, banking convergence with technology is the new slogan as such. It's difficult to distinguish, as I said earlier, between the technology companies and the bank. And as far as Doha Bank is concerned, we're the first one to bring in SMS banking, web banking, mobile, GPRS way back in 2002 onwards. So it's transaction-based processing all going to be digitally equipped, and customer will find the convenience as well as cost efficiency. That's good for the bank, good for the customers. And again, when it comes to tracking of the overall logging of the transactions, it becomes more meaningful. So the fourth industrial revolution, as we call typically, is already shaken up the momentum in terms of banking products and services. Customer value proposition is now converging towards Internet of Things, blockchain, artificial intelligence, robotic process automation. That's now the crisis COVID-19 is only accelerating the process. So billions of gadgets are available on your personal lifestyle as well as professional makeup. We have in a hybrid model, we are evolving to see that the banking is absolutely a convenient mechanism through this digital advantage. So digital governance is going to be a major thrust. As Omar has mentioned, cybersecurity measurements are going to be vital for us to see through. So it's a new world, a lot of customer convenience, and it's a value addition, and it's a win-win model. We have to embrace the change and make sure we create a positive value stream for all of the stakeholders.
I think, the attendees have endorsed what you just said around, I think, digital industry taking the center stage in things going forward. In terms of sector best position to recover from COVID-19 impact, a vast majority thinks that it will be the telecom sector, which is, obviously a proxy to the IT industry and other things also that people see. And then obviously consumer and then banking sector. So with that, I think I'll end the poll in the next 10 seconds, and we will then move on to the next discussion. See the results on your screen. So yeah, people are interested in gold, like always at the beginning of our webinar. Let's see where they end up with. With Seetha being there, I know they will be even more interested in gold towards the end. But let's see. People would trade next. Usually, a lot of people have never traded on the exchange, and but they are very much willing to trade within the next few months. Vast majority doesn't want to invest in the real estate at this stage, about 61% of them. and about 68% do not intend to take a mortgage loan in the next 6 months. And a huge 89-90% do not intend to take a personal loan in the next 6 months. As I mentioned, majority believes that telecom sector will revive very soon, quicker than any other. A lot of people are likely to make investments through ETFs, and they believe that the market will close somewhere in the neighborhood of 9,450 towards the end of this year. And on oil prices, majority believe that it will be range bound between $36 to $44. But so generally, positive outlook towards the oil price as well. With that, I think let's move to the next discussion point, where if I may invite Bassel. Seetha, we'll come back to you because we just had some discussion with you. But if we can move on to Bassel, and if you could share how you see the industry developing going forward.
Well, personally, I think actually that I agree with Seetha's and Omar's opinion on that. The way we're doing business is changing. Whether we like it or not, it has changed. And what has made it's not an option anymore for banks to adapt and for the clients to adapt. And it became a necessity, not an option. And that's what actually leading the shift in consumer behavior and accordingly in the bank's response to that. So I see the digital banking as a very important part of the future. The industry as we've known it, it definitely has changed. And I don't think there is any going back to that. It is the way that we're going to do business is going to depend to a very large extent on our reach towards the clients and our ability to fulfill the requirements digitally. And COVID-19, even if countries are opening up, it's not over yet. This is something that's going on for a while. During this period of time, people have to adapt to new ways of doing business, especially on the banking side of things. First of all, for the protection of people, that's one. Number two is the convenience, and people are driven by habits. Once they get used to something, they start getting used to it. But once those habits have changed, it becomes part of the everyday business going forward. Maybe it was strange or not very common for people to use the online banking and digital solutions a year ago. In the current environment, this is something that people are getting used to, and they're actually realizing the benefits of those solutions, because they haven't tried it before. So I think this is part of the future. On the banking sector, I totally agree with Omar's way of putting it. There are going to be challenges in the current environment and into 2021 as well. Things have been, I would say, with all over the globe, liquidity is being pumped into the banking sector and into the economies. This will definitely help reduce the implications on economies for some time. But this is not going on forever. So banks have to realize early that there are going to be pressures on NPFs or NPLs. There are going to be pressures on spreads as a result of the reduction in interest rates and the support that we have to extend to our clients as well. But things are shifting. The good thing is that as banks here locally, we are, in terms of liquidity, we are currently quite liquid. With what QCB and with the government has initiated in terms of support to the local economy and to the local companies and clients, both corporates and individuals, And this is something that is definitely going to ease the shock going forward. Let me go through my presentation very quickly. QIB at a glance. I'm sure most of the participants are kind of familiar with QIB. We're the second largest bank, largest Islamic bank in Qatar. Market cap around $10 billion, 500,000 customers. We have 1,100 employees, 26 branches as of today, 175 ATMs, and quite a strong call center. We have been investing in the digital offering over the past 5 or 6 years, and that definitely has helped us in the current environment. Our financials, as you can see, I would say they would speak for themselves. Alhamdulillah, we've done quite well over the past period. And if we look at the first quarter of 2020, our NPS ratios have been at the low end of the banking sector. We have a strong capital base. Our net profits was relatively stable compared to last year. And our shareholding structure, as most other banks during the financial crisis, Qatar Investment Authority is the largest shareholder in the bank. Going for the next slide, gives very simply a global economic outlook. Now we're not living in a bubble. We're living in the world economy affects the local economies and affects the regional economies. And the outlook, as you can see from the chart and from this in front of you, it is not a very nice or attractive, I would say, outlook in 2020, obviously, with the expectation that there is almost a 5% drop in the global economy, in the global GDP. And expected recovery in 2021 is going to compensate for that, assuming that things go normal. If there is a major new outbreak, I think there's going to be a growth of close to zero, at 0.5%. Going for the next one, it tells us about a regional economic outlook. Also, it's not a very good picture in terms of GCC, and the economic growth is expected to fall by 2.7%, and mainly due to the drop in oil prices. And you've seen the fiscal break-even oil prices. It is quite high for many of the GCC countries. Qatar actually is among the best in terms of break-even for the fiscal spending. And in terms of the fiscal balances, between 20 and 21, most of the countries are going to see kind of like a deficit in their fiscal balances going forward. If we look at the Qatar economy in the next slide, Qatar has been on actually most of, or all the rating agencies have given it a stable outlook with no change in rating, which actually represents a vote of confidence in the Qatar economy and how government has reacted to the pandemic. That's supported by strong net foreign asset position. It's the highest GDP per capita, among the highest, a leading exporter of LNG, lowest fiscal break-even oil price, as we've just mentioned. The government has embarked on structural reforms, not recently. That's something that has started a few years ago. And I think it's starting to pay off now with what's happening, or the crisis that we are witnessing. There has been a strong response to limit the impact of the coronavirus. We've seen a 75 billion stimulus package by the government, and that is definitely to support all sectors in the economy. We've seen structural changes in terms of the cost optimization that has started before, and it's actually going on as well. In terms of banks and profitability and capitalization, and we've seen the level of capital and liquidity before the crisis, and we've seen how well capitalized the banks the local banks in Qatar are. And we've seen, as Omar mentioned, at the early stages of the pandemic, there was a concern about the liquidity, but I think that's behind us today, with higher liquidity being pumped either locally or even globally. We've seen that improving definitely compared to the early stages of the crisis. And we've seen the Qatar Central Bank's reserves are at almost $40 billion. That's a record high compared to the previous days. The response has been quite effective in terms of what we've seen. If we look at the banking sector, going back to the banking sector, I have chosen 2016 and 2019 to see the impact of the blockade that happened in 2017 as well. If we've seen during those 3 or 4 years, the banking sector assets have increased by almost a quarter, 24%. Net profits has been on the rise for the same period. Return on average equity has been on the rise as well. And return on average assets has almost been stable. The cost to income ratio, as Omar was mentioning, is among the lowest in the region. We're currently at an average of 26-27% for the banking sector, and the capital adequacy ratios are the banks are really well capitalized at 18.6%. That's it's a burden for the banks because it actually affects your return on equity, but it adds to the comfort for the investors and for creditors. The coverage ratio, we've seen even an improvement compared to 2016. Banks have been taking a lot of provisions, and we've seen in the first quarter, we've seen a major rise in the banking provisions by almost 600 million, which is between 35 to 40% compared to last year. And as Omar was mentioning, you cannot assess by end of the first quarter what's the implications or impact of a pandemic on your clients and on the local market. And I'm also referring to what we have done as QIB in the next slide. Even we can go beyond that, and we've almost covered that. Yeah. All the 6 are number 1 in our minds. It's not like we're putting priorities here. Each one of those was actually working in parallel to make sure that the safety of people, whether the staff or the clients, is first, making sure that the business is operating business as usual as much as possible, even though we were working almost at 20% of our staff in offices and 80% are at home working from home. There has been an external and internal awareness. We've made sure that we do our social responsibility role as well. We have taken initiative in terms of postponement of financial installments, especially for the SMEs. That's what we started with, and then it went into bigger or larger corporates, and we are kind of an active participant in the National Response Guarantee System. On the digital acceleration, as I mentioned, we have been investing in digital for many years. We started in 2015, I think, with the change in our core banking system, so that we can invest in more digital solutions going forward. We have seen some KPIs that are really encouraging in terms of the penetration rates and the registrations and the usage as well. And you can have a lot of people registering and not using. We've seen a usage quite encouraging. Comes with the digital age, you have to be very alert in terms of the cyber security and infosec. And this is key for clients, for regulators, for any bank to be on top of things, together with the risk management on the operational side, or the operational risk management of things as well. This was something on our top priorities. And you have to manage while you're investing on digital and going to more towards the digital solutions. You have to have a solid cyber security and IT security infrastructure and operational risk management that is on top of things. And together with that was the cost containment. As I mentioned, there is going to be a lot of pressure on bottom line for banks and for all industries, not just banks. For cost containment is becoming a key part of that. Our cost containment measures were definitely on the non-critical expenditures. We have taken, I would say, steps to make it more efficient and as much as possible, yani, in line with the industry. For the next slide, to conclude, I think things are definitely, we're in a good position. We cannot say we're in a bad position, we are in a good position. The government has given very strong support to the market through direct incentives or through the Qatar Central Bank actions and through the National Guarantees Program as well. That was definitely kind of, first of all, support, and it gives confidence to the market in general that things, yes, we are in a crisis, but we'll get through that crisis like we've done in the past. As I was mentioning, people's safety first, business and individual support in time of financial uncertainty. You know, banks are always known, yani, that they're holding the umbrella when it's nice and the weather is nice. Once it starts raining, they take away the umbrella. Hopefully not this time. We are as supportive as possible to our clients, and this is part of our business model. Yani. This is what our banks are supposed to do. And we want to ensure that we are enablers of the start of economy once again, as we continue to have or give efficient access to credit for our clients. We see limited impact on the government spending. We have commitments for 2022 that cannot be postponed. There are going to be cuts in the spending, but the majority are going to continue, and that also creates stimulus for the local economy and creates opportunities for banks. In terms of government's existing diversification and self-sufficiency, we've seen that as part, actually, like it started after the blockade, or even before that. And we've seen the start of many initiatives even before the blockade. It definitely helped during the blockade time. And now I would say that this initiatives that the country has taken is definitely helping in the current crisis as well. Bottom line, I would say that the industry model or operating model is changed, and it's going to continue to change, and there is no turning back. And this is the way the future is. And I think that concludes my remarks. And the last one is simply, which I'm very proud of, the awards that we keep collecting. Happy to take any questions when you want.
Brilliant. Thanks, Bassel, for your insights into how the industry is going to look like and what your bank priorities are and have been during this pandemic. We will go towards the Q&A a little later, but before that, I would like to move on to Dr. Seetha to have a discussion on how his bank has navigated the pandemic crisis, the COVID-19 crisis. And I mean, are there specific changes you're going to make to your business model, the banking business model that Bassel was just alluding towards? Do you have a game plan in your mind?
Thank you, Moshin. Thank you, fellow speakers. Bassel has summed it up in terms of global economics as well as the local economy. In substance, let's look at in 4 parts. One is the impact. The second one, I think I should attempt, some of the poll was showcasing the financial markets, whether oil or gas or precious metals or fixed income or equities. We'll see what is the likely outcome in the coming days. And again, well, let us also look at the changing business model and what sort of regulatory compliance is going to come in, including ESG, environmental social governance is going to play a bigger role. And again, social risk management will be integrated into the risk management framework. The last but not the least, what sort of digital acceleration I see and what exactly the Doha Bank is doing in substance. Impact in global terms is very much clear. We have been continuously getting measurements from IMF to start with in April that was defined by OECD. OECD said in the first wave itself, it will be resulting not less than 6% contraction. That is great recession in substance. And again, last week when the IMF was precipitating in terms of global growth, it was an absolute contraction to the tune of 4.9%. That says it all. This year is going to be challenging. When there is a contraction in global frame, let's understand we are living in an interconnected, interdependent world. Nobody is immune to it. No asset class is immune to it. It's a question of making sure that how much impact it's going to have in your trade or investments, banking or finance. The economic momentum will have direct impact in the monetary policy as well as fiscal policy. The governments have taken world over an alignment between the monetary and fiscal measures, and they have promulgated to improve the liquidity so that the funding is available. It doesn't result in solvency issue. Countries can collapse as well if you are not taking alignment between monetary policy and fiscal policy. And that is precisely the reason world over, and not less than 10 to 12% GDP has been the minimum stimulus. It means individual institutions, you have to put money on the table. You have to improve the servicing capacity. You have to give concession values. There's a total disruption in terms of the business. It's a paralysis. It's not even a disruption. It's a complete, if you have lockdown, it says it all. It's a complete paralysis in substance, and no industry is immune to it. If you look at it, everyone is interconnected within the framework, and economies have to contract. It means industries have to contract. It means banking has to contract. There's no possibility of acceleration in terms of growth, even individual management. If you do it, it's a short-term focus. So, objective demands, conservative and cautious corporate management is name of the game. Now, in substance, the impact will be in terms of economic governance, globally, regionally, locally, even in corporate management. The second impact is to be on the social governance. It means right from the social distancing, every institution, the bank is social distancing was formulated, hygiene was factored, and again, security was managed in common substance, and we are boosting more green recombination activities. We'll have more reduction in creating, carbon emission reduction will come in. Carbon neutral society will be created. That's good for the environment and good for society as well. Social governance, whether it's healthcare or education or water management or waste management, you will have that serious reorganization in terms of the business model. When it comes to human development, this is the key. Ultimate peace, we have to understand everything is humanity and human growth. We have serious consequences we are seeing now. I think over 10.5 million people are impacted in around the world. No country is immune to it. When it comes to individual countries, we have the statistics which is alarming. The second wave is already started, and over 530,000 people, as on date, it will counter this crisis. The second wave will have a much bigger consequential impact. We are ruling out 2020 in terms of the economic momentum and the contraction, and possibly if there is a clinical and medical solution, then we are going to have a major reorganization in terms of economic momentum. That remains to be seen. That's only a guesswork indicative measurements. But I'm of the opinion it's not going to recover even in 2021. It may not be a contraction in total respects if we clinically get a solution by end of this year. Clinical tests around the world, 130 clinical laboratories now working on it. If we administer 6.8 million people in this planet, there is a possibility we may revive from new normal to normal in a gradual substance. So that is what we should keep in mind. It's not a short-term crisis. It's here to stay a minimum of 2 years, and normalcy will be restored if and only if these precautions which I mentioned. So there is a huge healthcare, and we have to necessarily look at the human governance in a different prospects. Disruption in every form for human subsistence, survival, and that's it means we have to map every possible aspects of humanity: education, healthcare, food security, water management, as I said, waste management, under the water, or the water, also including other clinical hygiene for animals. Everything is required for us to see. We need to build a global partnership. Global partnership. Everyone is interconnected. So that's the next one. When it comes to economic governance, individual institutions have to redefine. Countries have to redefine their game. But let's also understand, in a global makeup, you have trade, which is contracting 30 to 32% contraction this year. That's what the WTO says. WTO chief was mentioning 2 months before, 13%. Now he revised his outlook. Now, trade is going to be impacted whether merchandise or service. You will have an impact. Financial economies, even financial institutions have to necessarily understand if trade is impacted, your foreign exchange is impacted, your business model is impacted in terms of exporting, and that's disruption, financial service as well. Now, when it comes to the rest of the alignment in terms of economic governance, investments, there are huge financial risk in the markets simply because the currencies are overvalued. Already we have done printing money in 2009. Dollar is overvalued, for example. Dollar has to crash. Let's understand. The gross debt to GDP, if you look at it, it has to crash. That's the single currency which is driving 70% of the global trade. So let us understand this will have consequential impact in every single measurement. If you don't factor it, your vital risk becomes more monumental and you will not be able to recover in individual economies. So there is financial markets are nothing but gambling grounds today. Whatever be the prediction, let's understand the reality. It is going to be a gambling ground. Stocks are overvalued around the world. Global equities you mentioned, that's vastly overvalued. PE, price to earnings, is 28 times in the American market. Is it sustainable? Is it sustainable? No. That's Qatar. Because price to earnings, we have seen, economic fundamentals are matching. Stock market is a barometer of an economy. If that is not linked in substance, if you are overshooting because you have hard money transcending borders, that's not sustainable. Whereas economic fundamentals are strong. Countries like Qatar, where you have strong commodity-driven value streams in terms of revenues, there is a possibility. And our price to earning and price to book value, if you look at it, is grossly under before the COVID crisis. So I'm here to say global equities are grossly overpriced, and Qatar equity is grossly under. Look at it, revenue stream, even if there is a regression of 10 to 15%. In the coming year, you will have a price to earning. It's worth taking to 15 to 18 times. That's still not a market average in global terms. When it comes to investments of asset class, we know interest rate has been fixed. There's no increase in the interest rate. We have seen America has spelled out clearly they cannot increase the interest rate. They are not thinking. Federal Reserve Chairman has mentioned very clearly. They are not even thinking of rising the interest rate. And that's what exactly the word. It clearly signals. Market indications are next 2 years there will not be interest rate hike. It tells you fixed income is going to be a product to watch. People want safe and secure, capital protected debt papers. Underlying economies will drive the change. Fundamentals are driven when it comes to fixed income. Majority of the cases, it's not. You can't widely gamble because the parameters which you have to look at it are all synchronized by and large. So fixed income will be steady. You have to look at country's rating and the corporate rating if it is a corporate bond. If it is a sovereign rating, you have to look at it. If it is a US Treasury, you have to look at it. Country's GDP to gross debt, you have to measure it. If it is abnormal, you have to be careful. In countries like Qatar, for example, gross debt to GDP is 52%. We can see clearly the way forward. Sovereign debt, Qatar can still issue. They can mobilize. Last time when they issued in May, it was oversubscribed by 6 times. Now we can see Qatar can go for additional dollar procurement, if at all, and they will have good subscriptions. And again, it's a good investment from a market perspective for the international investors of private equity or hedge fund holders. I'm only answering the question, some of the poll questions which have been asked in terms of economic governance. So when it comes to,
if I may, sorry, because some questions are coming in, and I thought we'll direct them while you're speaking.
Yeah.
I think you clearly mentioned around the ESG element also, which will be important in terms of being used as a tool for risk management, better risk management of the companies. Omar, if I could direct the same question towards you around ESG, do you see this becoming core to the renewed business model of the banks going forward, and then taking a little extra care on the ESG front?
And no, thank you for that, Moshin. I saw that appearing in the chat box as well. Look, I think ESG, obviously, there's been a lot of talk about ESG over the last couple of years, and I think this is not something that banks in Qatar are beginning to adopt only now as a result of the pandemic. I do think over the last few years, and also months actually, we've seen banks in Qatar actually ramp up their efforts around ESG, whether it's sustainability reporting, whether it's looking at diversity on the board, whether it's looking at their own lending and risk management practices. And I think the current situation will only further fuel that and fast track that process. I think going forward, similar to digital, where you can't really look at digital or ESG now in silos, really digital and ESG will eventually evolve to become linked and core at the ethos of everything banks do. So I certainly think it's not something new. There is work to be done. We've seen banks look at issuance of green bonds, for example, over the last couple of years in Qatar. So I think going forward, we will look at transactions, see more transactions and more practices and culture evolve to have ESG really at the core, whereas at the moment, it's really maybe slightly at the periphery.
Moshin, if I can add, Qatar has announced it since 2016 rather. We have been issuing this document since 2009. If we look at the information which we put in here, it's set to global universal standard as such. We have signed with UNESCO in 2006-07. We have made sure green banking as a structured practice, we did it. Whether investments or lending, water conservation or district cooling, or eco-school program in terms of, it is going to be, see, you are part of the society. You have to care for the society. Then only a good corporate citizen can add value to good economy. Money making is one aspect. At the same time, how you make it, how you add value to society. And creating a financial literacy has been our forefront. Creating sustainable value is our forefront. And that's how we channelized our energy and we are complying in respect, and that should be a new norm. That should be
clearly. I think Doha Bank has been at the forefront of sustainability reporting. I think you were one of the first banks in Qatar which actually got included in FTSE for Good series of indices, which gauges the countries and companies' ability and readiness for ESG reporting and following the global UN SDG guidelines. So no, I think that's always been a pleasure to see how Doha Bank has performed on the ESG front. Recently, QNB also started to publish their sustainability reports. Bassel, how is your bank gearing towards the ESG acceptance and reporting?
Well, I will not add much to what Omar and Sita has mentioned here. What we have done actually is that we mapped QIB's activities versus the UN 17 sustainability guidelines or development goals. And I see there is definitely room for improvement and way to go there. It is something that was started already, and I think this is part as well of the future. And now we're working in more of a global environment rather than just a local environment.
Yeah.
We have to adapt and adopt international and global guidelines and global trends more important or becoming more important. We're not living in vacuum. But I think this is something, as Omar mentioned, that majority of banks are, it's a work in process and work in progress. There is still a way to go. So at least we started. That's a good thing. The start is always the most difficult step. Once you start, there is no turning back, and it's a way of actually changing some, not all of your some parts of your business model or operating model to be in line with the global requirements there.
Yeah. I think we have more questions coming in from the audience, so I'll just read a few of them. I think one of the interesting questions is around the job market in the financial services industry. As we know, the whole industry starts to remodel and reshape. What kind of skills would you be looking for going forward? And when will you be hiring? I think that's an interesting discussion our attendees wanted to understand.
Question is posed to whom?
Both of you, Sita and Bassel, you guys are the banks.
Sita, beauty before age, yeah, please.
Listen, let's understand the dynamics of the new world. It's a flat world. It's moving from, it's a change of shape. Now, you don't have borders. Knowledge process outsourcing will have a digital advantage, and you can pick up, now with the split of the staff, you can also learn lessons. You are not location centric, you are information centric. So essentially, irrespective of where you come from, you can hire for any institution. So you will get the best of talent, and you will have a cost-effective way forward, because the prices will be flat down. It's skill matrix and job descriptions which will iron out the price. It will not be different whether it is America, Bangladesh, or India, or Japan. You will have, this skill will have the uniformity in price. The price discrimination which we are seeing today because of segmentation, you are focused on locations, is no more required. There are certain competencies which are required to have a front-end face, but internal integration will happen. Majority of the engines will come from the knowledge process outsourcing, and these surveys will be channelized in a pipe, and big factories will support this outsourced process, and you will find continuous recruitment for big corporates, and they will outsource the knowledge. They outsource the business in multiple forms. Core competencies you will keep. If you look at the intellectual basket, you will keep only core competencies. Technical skill, for example, for a bank, I need a foreign exchange dealer. I need, again, relationship managers. And I don't need certain segments. You don't need. So what you will do is peripheral competencies, you will outsource it in total terms, and it will be cost effective for you. And similarly, your recruitment will be confined to a global market, not necessarily local market. So this kind of knowledge economy will get evolved, and that will redefine the game. So it's a huge transformation in substance. Every institution has to recruit because the changing business model is coming. This is another major transformation. Every part of corporate banking or retail banking or treasury or investments or international technology or operations, everything is going to be a complete change. If you calculate the dynamics of this change, then you have to reinvent the wheel in terms of the staffing patterns and staff spans.
From location-centric to information-centric is where the skill set moves, and uniformity of pricing because of that specific demand for the skill set. Bassel, how do you see this evolving?
I don't think I'll add much to what Sita has mentioned now. I think that the skills are going to be different going forward. The skills requirements are going to be different. But in that respect, what we can do and what we are doing is training. And all our I would say staff base, what we can do is that we can redirect them to other areas of the banks where the same level or same number is not required as such. It's a matter of training and developing the skills and encouraging the skills that are needed going forward. I think it's very important in the current environment that people would understand that it is becoming more competitive. And the talents are available to some extent, but there are some kind of talents that are not available, and you have to pursue strongly going forward. But there is a shift as you are changing the operating model of the banking industry in general. There is definitely a change and shift in the required set of skills that are going to be required. But I think with training and adding to what we have certain level of that skills, I think the operating model would go smoothly.
Okay, so I mean, from what I have heard so far from both of you, it appears, and from in fact all three of you, what I've heard is it seems that the banking industry is just entering the fourth industrial revolution, and it's going to be new skill sets, new dynamics of how the business models operate, what the key drivers would be. You mentioned, Sita, outsourcing. So with that, I look at Omar. How well positioned are you to offer outsourcing services to the banks? I mean, is that something you are also looking at with the changing dynamics?
Yeah, I mean, more from a banking sector perspective, in terms of outsourcing, we've seen in the past, certainly a couple of years ago, we had local banks on the conventional side that had outsourced a lot of their back office and operational type roles to offshore providers. I think the regulator was very clear, and has also been very clear since then, that the preference is to retain onshore whatever can be retained as opposed to offshore, just in terms of data privacy and also making sure that processes are retained in country. So I think since then we did see a shift somewhat, and that particular institution did bring onshore a lot of what had been outsourced to the third party. But what we have seen in recent years is banks look at exploring setting up institutions or entities in Qatar, but to deal holistically with a lot of processing and operational type matters in terms of bringing in skills from outside, having them residing here, and improving and increasing efficiency and helping the way data is managed. So I think going forward, we may look at that from a cost efficiency perspective, from a data perspective, and also just centralization. The situation that we've seen here over the last few months, particular banks who have centralized those functions and not necessarily offshored them, but outsourced them to captive institutions within their own banks, have actually seen the benefits of that. So I think banks will look at some form of centralizations going forward, I'm not sure if we'll see a lock, stock, barrel of movements to offshore outsourcing, but potentially in country and centralization is the way forward.
Interesting. So yeah, that's an interesting take around data privacy, also where regulators will step in when it comes to outsourcing. Now, I think we're moving towards the conclusion of our webinar session. Usually, I like to conclude with a one-word question answer, sort of a rapid fire, if I may call it. So look, and it will be for all three of you. Looking beyond COVID-19, what is one word that pops up in your mind when you think about the strategy of your bank going forward? If I may start with Bassel, one word that pops up in your mind when you think of your future strategy.
Focus and resilience.
Caesar, what's the one word that pops up in your mind?
Value creation.
Value creation. And Omar, how do you see that? I mean, when you have to advise your clients on strategy, what's one thing that you would want them to focus on?
And if you say one word that pops up, the first word that pops up for me is transformation. Certainly what we're seeing now is a transformational change that we'll see into the foreseeable future.
All right. It is very clear that you have been a very successful consultant over the last many years. You've just plugged, I think transformation is what it is that we are going to see forward. It's digital transformation, it's business model transformation. It's just looking at things differently, looking at people, talent differently. So definitely, I think this is a new world that we are embracing, and depending on how soon each entity starts that journey, it will define their future. Now, before closing the webinar session, I would again go back to the poll where we ask the attendees again to take the poll of the same questions again, which they voted before on, and see if they have a different idea about the discussions we had. And then while we are seeing, I think, and waiting for the audience to vote, if I may ask you, Bassel, in terms of Islamic banking and the reliance on quality collateral for extending loans, how exposed is the banking sector to the real estate sector? And then how do you see that risk resolving?
Well, I think it's not something that's only for Islamic banks. Generally speaking, in the local market or in the regional markets in general, you will find a higher portion of the portfolios are towards real estate financing or collateralized by real estate. Yeah, I think what is important is to differentiate between different segments of the real estate. It's not just general real estate. There are different segments or classifications under the real estate, and valuations of the real estate are very important in that respect. We have been, and I assume many others have been, quite conservative in their approach in the past. That definitely is helping us today in terms of coverage and in terms of quality of the real estate that we have financed. That's why in QIB's case, our NPFs are very low compared to the region or even locally. So I think we have to differentiate between the asset class, and we have to differentiate between a risk management appetite or the risk appetite towards the real estate financing. But in general, we're still financing a business rather than financing an asset. We're financing time. We're financing a business that generates cash flows. It's not just financing an asset with no cash flows, underlying cash flows.
So, I mean, while we are waiting, I encourage more attendees to participate in the poll. Please look up on your screen the poll button and participate. The poll is still in progress. Sita, a more futuristic question. Do you ever see banks going completely digital, completely transforming from what they are today to being completely digital?
That's the model evolving. I mean, the digital-only bank will be a transaction-based processing. Everything can be done to digital governance, and it will be the most efficient mechanism. Value advantage to customers. Again, whoever investing in such mechanisms will start to gain as well. The brick and market story is over. Brick is information. Essentially, digital-only bank will be very conventional procedures, policies, everything will get into higher digital automation, and the companies will become totally digital. That's what virtual reality is all about. That's what artificial intelligence is all about. That is what is robotic process automation. If you converge as a digital-only bank, that's going to be the way forward for you to do, whether it's corporate banking or retail, treasury, or every part of the banking system can be converged through the technology and the tools available in today's context. Why to waste customer time and your time and move straight into a virtual world and give the value advantage as one-stop financial service, collaborate and complement the values to the customers. And that's the model. It's going to be the breadwinner. Perhaps there will be a huge competition between technology companies, which are still to be regulated. That's the concern I have, because technology companies have to be regulated, and telecom companies have to be regulated. There has to be, clear governance in terms of monetary and fiscal alignment to govern these institutions, and that's what is missing link. Otherwise, you will have virtual companies will be doing financial services, digital-only services, and catering to all sort of customer segments which a conventional brick and mortar can adhere to.
All right. Thanks, Sita and Bassel, for your remarks during this poll session. I would end the poll and start to share the results. I think you'll all see them on your screens. Gold is slightly more preferred towards the end of the session. So that's an interesting outcome. And people do intend to trade on the market in the next few months. I mean, on the real estate front, yes, it's the same as it was at the beginning of the poll. Not many people are intending to buy real estate. No intentions of getting a mortgage loan or a personal loan. And vast majority believes the telecom sector will recover first in terms of impact from COVID-19 pandemic. People are interested to buy ETFs, and market will be range bound, hopefully ending towards mid 9,500 range. And oil also is expected to remain range bound towards $40, $44 range. So that, I think, brings us to the end of our poll discussion and the webinar as well. I would like to thank all of you for your time, the attendees and the panelists, the esteemed panelists. Today is a busy day in the banking industry. I'm sure a lot of board calls must be happening in terms of how to react to the news that came out yesterday. So all the best as you chart the future in these current times. And we will definitely be back soon with another topic on COVID-19, but now looking certainly beyond the restrictions and the lockdowns, and as the economies start to open up. So thanks everyone, Omar, Sita, and Bassel. Thank you for your time, and thank you everyone.